Welcome to Riches in the Niches Investor Podcast. Here's your host, my dad, Richard Sosa.
Welcome to the Riches in the Niches Investor Podcast. This show covers investment opportunities in markets that are relatively unknown to the average investor. Through in-depth conversations, we learn how money managers, company executives, and other leaders build an edge one niche at a time. I'm your host, Richard Sosa, and this is Riches in the Niches. Today, I have the pleasure of sharing my conversation with David Waters, managing member of Alluvial Capital. Since inception in 2014, David has been able to achieve great returns by investing in mostly unloved and underappreciated OTC pink sheet stocks. Today, David and I open up the podcast and speak to investors about his largest investment, P10 Holdings. Now listed on the New York Stock Exchange under the ticker PX, P10 is a platform company that provides access to a suite of best-in-class, niche-oriented investment managers in private markets. Led by Robert Alpert and Clark Webb, P10 has transformed the way many of us view public holding companies. Let's niche down with Dave Waters. Dave, thank you very much for joining us tonight on this Spaces event. As the third guest of the Riches in the Niches Investor Podcast, we value your opinion on all things OTC pink stocks. Few things. One, do you own P10? And two, tell us about yourself and the company.
Thanks, Richard, for the intro there. It's always nice to talk to you, and I appreciate you having me on. So before I even get going, let me say that I am definitely a shareholder of the company that we're speaking about now, P10. So my opinion is biased. None of this is investment advice. Don't do anything as I say. Don't go out and buy this or sell it or whatnot just because it's something you hear here tonight. And yeah, not advice. So we'll keep it simple and get that out of the way. My name is Dave Waters. Like Richard said, I am the founder and portfolio manager of Alluvial Capital in Pittsburgh, Pennsylvania. So nice to talk to all of yins tonight. I see a lot of familiar faces, a lot of people I've talked to and met a few of you in person and talked on Twitter or email or whatnot. And that's awesome. One of the reasons I'm on Twitter is to have great conversations and get to know people. So don't hesitate to reach out at any time. Also want to shout out my associate, Tom Capper, who I see is also listening in tonight. He's an integral part of the Alluvial team, and it's a small team. It's two of us. So yeah, let's talk a little bit about P10, which is my largest position and has been very, very good to me over the past couple years, and I'm very, very grateful for it. So at Alluvial, what we do is we try to profit by identifying opportunities and little known, overlooked, obscure companies. And when we happened across P10 in 2019, it definitely fit the bill. So today, P10 is a diversified alternative asset manager that, as Richard mentioned, is making its debut on the New York Stock Exchange tomorrow morning. Probably will start trading, 10:30, somewhere around there. But it was not at all that when I came across it in 2019 or thereabouts. And in fact, I actually owe the company itself a little bit for helping me find them. For years and years, I've written on this blog that was formerly OTC Adventures, and now I've moved over to Substack under the Alluvial name. But I would write about interesting little companies I found, and by doing so, I developed a pretty good network, and a lot of people would email me or call me, and we would talk ideas, and it was just a nice thing. And so one day, out of the blue, I got a phone call from this guy named Clark Webb. And Clark told me that he and a partner had just taken over a bankrupt shell company. They had injected about 5 million into this company for a 49% stake. They had a ton of NOLs that they preserved in this transaction, and now they were looking for an acquisition. And Clark wanted to know if I had anything on top of my mind that might be good for them to take a look at. And the answer was no, unfortunately. But Clark sounded so driven and so smart that I thought, this is a guy I'm going to track. And this company, which at the time was Active Power, was a company that I thought was worthwhile. So I kind of kept tabs on it for a few months. And then it wasn't that long after that, maybe 6 months or so, that I saw they announced an acquisition. They were buying RCP Advisors, which is a lower middle market private equity shop mainly doing funds of funds for institutional investors. And the price was good. I liked the strategy. Obviously, they were executing on a plan, and so I bought some shares. And the more comfortable I got with the company, the more shares I bought. And they kept on executing, and they've gone out and purchased additional alternative asset managers in private credit, in venture, and in impact investing, sort of a socially conscious slash ESG approach. And the business has just grown. So it's been awesome to see them succeed in this business model, and the share price has responded in what a way. I bought my first shares at around 90 cents, and of course, as investments do, it immediately dropped to 70 cents, but I kept on buying. And at close today, I think it was just over $11. So it's been quite a ride, and I wish I could say I still owned all the shares today that I did a year or so ago, but I've had to sell some for risk control reasons. But I remain a large shareholder. I think I'm one of the largest non-management shareholders that the company has until tomorrow, when they sell a whole bunch of shares and welcome a whole bunch of new people into the investment. So I know that's a very cursory introduction to the company, and there's a lot of questions out there. And I'd love to help people understand this company and talk about what it is that I think is so great. So yeah, before we open it up for questions, I'll just say a quick bit about the management team that's in place. So like I said, there's Clark Webb is sort of one half of the mastermind team behind this business, and the other half is Robert Alpert. Robert Alpert is a guy who's been around for a while in alternative assets and private equity. He ran a fund for a while and got involved in private equity, and he has a great network, and he is sort of the relationship guy. And Clark Webb is a younger guy. I mean, I don't really consider myself young anymore at 36, but he's 37 or 38 and probably closing in on $1 billion in net worth, and he deserves it. He's done very, very well. And so congrats to him. But it's just they hustle, they're smart, they're ethical, and I respect these guys a lot. I congratulate them for the success they've produced, and for the returns they've generated for shareholders along the way. So yeah, I mean, read as much as you can from them, talk to them if you can to understand the business, and they're guys to watch. I have no doubt that P10 wants to be another Blackstone, another KKR. And of course, they're years away from that, and they have a lot to prove before they get there. But I think they're off to a great start. So yeah, happy to talk about the business model, the economics, the plan that the company has for the next 5-10 years. Caveat being that it's all my opinion. So Richard, would you be able to open it up for questions?
Yeah, no problem. Let me open up. I mean, I have a bunch of questions I can ask if nobody asked, but I see some requests already. So if you
Great.
have a question, I'll patch you in, and then we can go from there.
Perfect.
I think the first question is from James. James, how you doing?
Hey, Dave and Richard, how are y'all doing this evening?
Good. How you doing?
Hello.
Hey, doing well. I was just curious on your thoughts. Is there going to be an announcement following this offering where they might lay out kind of a strategic roadmap, or is this purely an offering and information will follow as need be, or is there some type of guidance that'll be immediately provided?
Yeah, good question. So I highly recommend checking out the roadshow presentation they did. That it's out there, it's available. They do a really, really good job summarizing the business, how they got to where they are now, and what the future looks like. So yeah, and this is also going to be their debut as a fully SEC registered, regularly reporting company. So they'll be a lot more open about guidance, about plans. They've kept it kind of close to the vest up to this point, being an OTC listed company and not an SEC filer, and so they've not been the most communicative. But that will definitely change. I mean, they've kind of started spreading the word and leading up to this IPO, and yeah, I mean, and they're going to be a $2 billion company following this, so they're not small potatoes anymore. So yeah, I think they'll definitely do a lot more in terms of laying out the roadmap and their AUM targets for the near and middle and medium term. So yeah, expect the company to do a much better job of communicating in the weeks, months, and years ahead.
And just a quick follow-up to that. Obviously alternative asset management space is one of the fastest growing asset classes. And as we look, more into that, the tax niche tax credit space, whether it be for wetlands mitigation or renewable mitigation, things like that. Those are certainly areas I'd like to see them hone in on, where I think there's a lot of value to unlock. So just wanted to get kind of your couple words on that.
I would actually be shocked if they weren't already looking at areas like that, especially their enhanced capital subsidiary, which does exactly that, which does social, pro environmental, pro social development, lending and investing, and so. I mean, but, hey, it might not hurt to shoot an email or ask about that on a quarterly call or at an investor day, because if they're not aware of it, I'm sure they'd love to be aware of it.
Perfect. Thanks so much. Yeah, I just think, especially when it comes to wetlands protection, whether it be the United States Gulf Coast or, California or the East Coast, I think there's a lot of value to be unlocked in that space. So yeah, I appreciate it, guys. I'm going to pass the mic.
I did want to ask you, Dave, what do you think their value proposition is to prospective? I mean, look, a large part of this company is buying, partnering with asset managers. What do you think their value proposition is to the asset managers?
Yeah, great question. I mean, that comes up an awful lot. 'Cause, alternative investments, fantastic business. I mean, it scales like crazy. That the margins are ridiculous. At least for now, you get pretty nice tax treatment if you're a principal. And it's hard to say, like, well, what would make somebody sell? Well, a few reasons. A big one is diversification. I mean, if you're running a lower middle market private equity company, or you're doing venture or private credit, you're a cyclical thing. You're going to have some really, really great years, and then you might have a few really tough years. And also, you're really only as good as your last fund. I mean, you might have 2, 3 good funds in a row, and if your third one is a total dud, it might not even be your fault. Might be the point of the cycle. You might be washed out. You might be done. And so, for a lot of these people, it makes sense to get some diversification. You sell your fee stream to P10, and no matter what sort of manager you are, you now have exposure to a diversified set of alternative assets. If PE is cold, then maybe credit's good. If credit's bad, then maybe venture or social is going well. And so it's a risk reducer for them, especially people who've maybe spent 20 or 30 years building up a great practice and would like to take some chips off the table. It can be a great exit for them. I mean, also, it provides a currency to reward your younger associates and incentivize them to stick around and benefit. I mean, that's one of the troubles of running a private business is how do you provide equity exposure for your junior employees and for people who are coming up. It's not as easy as it is with a public company. You have a currency, so that's another reason. And but a lot of it is, I mean, they try to, and they say they do this. I mean, time will tell how successfully. They want to do the Warren Buffett model, where they are a great home for great businesses. They consider these partnerships permanent. I mean, that's language that gets tossed up there a lot. Uh, only time can tell if that's true or not. But they say it's a permanent, friendly place for alternative asset manager to reside. That they're not going to interfere too much with the business. They want to provide cross selling opportunities and some back office support. But otherwise, these managers still get to run the business the way they like to. And it's not the sort of thing where 10 years from now they'll be flipped to a worse organization or something like that. So yeah, between those three things, I think they have a pretty decent proposition that won't work for everyone, but can be attractive to a set of alts managers.
And Dave, can you talk about the NOLs and how much they have and how long do you think it'll take them to work through it?
Yeah, great question. So they have about, and I mean, don't cite me on this at the top of my head, but I believe they have around 400 million in NOLs that have a pretty decent runway for them to use. But honestly, one of the big differentiators about these two guys is their success in utilizing NOLs. I mean, if you look at the whole like NOL shell, NOL strategy over the past 5 years, it's been kind of bleak. Not a lot of operators have successfully taken over NOL shells and being able to utilize those NOLs before they expire. Or I mean, some of them end up back in bankruptcy again, like Real Industry a couple years ago. But they've done it well. They've done it right. And so I think the chances are very, very good that they use up these NOLs over the next few years. On the other hand, they very cleverly structure these acquisitions to generate additional tax shields. I mean, you buy an alternative asset manager, you don't get a lot of tangible assets. Your assets are the people, the men and women who make up the organization, and they are your moneymakers. And so when you buy these managers, you end up capitalizing a customer list, you capitalize a management contract for the existing set of funds, and then you amortize that over the life of these assets. And so you're producing a ton of cash flow up front, but you're not necessarily producing a lot of taxable income. And that comes years down the line. But I do think that P10 wants to build up its roster of assets and managers quickly enough to start producing pretty substantial gap net income, which can then be used to effectively utilize those NOLs, which can shield a lot of taxable income, especially if corporate rates go up a little bit, which it seems like they might.
It's remarkable. I mean, this is how I see this. This really is a platform company. It's using this NML shell, and it's like in the ideal way, where it's almost like it's a win-win-win for everyone, right? The asset managers win, the holding company wins, and hopefully, well, the shareholders have won, but I think they're starting to see what the company's trying to do, and utilizing this shell really in the perfect way, which is rare. Which I've seen so many of these things fail. I mean, as a value investor, I kind of love, the dealness of these NOL shells, and how everyone wants to go out and make the cheap deal, right? Buy the company at a nice discount, and they almost always they blow up, right? And in this case, they're buying real asset managers that are generating nice fee income, and utilizing the shell in a way that is really creating something that will probably be here well after the NOLs are gone. Since no one else is going to ask, I'm going to ask probably the hardest question. I think we've got given a good overview of the company and what they do, is really how to how to value this company, which is hard because so much of it's composed of what they're going to do in the future. How do you look at valuation? How should an investor look at valuation?
You're exactly right that it's not the easiest thing because it's a moving target. I mean, P10 is different today than it was 6 months ago, and 6 months from now it might look entirely different. But I really think of this as sort of like a classic equity bond. If you look at all the companies in the market, P10 will be one of the most predictable, if not the most. You can know almost to the penny what their earnings will be for the next quarter, but just based on the fact that they have these guaranteed contracts where they know what they're going to make year after year after year. I was talking to someone else who was on here the other day, and I was saying, like, I know of no other company where just by looking at them today, I can tell almost with full certainty what their minimum earnings will be 7 years from now, just based on their existing contracts. And honestly, that is worth a lot. I mean, we sort of more traditional value investors sometimes start to get really itchy when our stocks move up past 20, 25, 30 times cash flow. But I think if there has been any lesson for value investors over the past generation, it's that some businesses really do deserve a premium multiple, and not just a slight premium, and that we should not be afraid to pay those multiples when it's justified and then some. So essentially, I think what we'll see is the market capitalizing P10's cash flow at a pretty low rate. I mean, maybe 3 or 4% is fair on an earnings yield basis, because that they're going to have pretty predictable organic growth. I mean, if they just grow their AUM by 5% a year, which is a really low target, they'll easily get that in EPS growth. At the same time, and there's a lot of inorganic growth opportunities from their pretty active acquisitions process. So, I mean, I don't want to put any targets on it, other than I think it's worth more than it trades for now. But it's a unique business. It's unbelievable. The quality is a really rare thing. And the market is frequently willing to capitalize that at a very, very high ratio. And so, yeah, I don't think 30 times recurring cash flow is out of the question. And on top of that, there's your optionality for the acquisitions. And I guess another important differentiator that, because a lot of people will come out and say, okay, well, this business, it's like a mini KKR, it's like a mini, it's a small private equity, but they don't really do any principal investing. And that's the thing about, Apollo or Fortress when it was public, or KKR, is they have a lot of investments in their own funds, and that and those earnings don't get capitalized at a high rate because they're so unpredictable. I mean, some years they're enormous, and then they might be zero for a couple of years. But P10 doesn't have that. All they have is the management fees, which are just as predictable as a metronome. And so I don't think we have to worry about the market not seeing the quality or not being willing to capitalize that adequately, just because it is literally so predictable. And it's a royalty on the growth of the alternative space, all the way from private, all the way from equity to debt to venture to socially oriented investing, which I think is only going to grow. I mean, in a low rate world, pensions, insurance companies, endowments, and institutions really have no choice other than to go to alternatives to try to meet their return objectives. And you can argue and worry about if there's any sort of systemic risk from that, and there probably are, but that's not going to change the fact that the trends are so strong in alts.
Well, the other great thing about private equity and the alternative space is they're definitely not as volatile as the public market. So they have that going for them.
At least on a mark-to-market basis, but very true.
Correct. Correct. What are the best comps for this company?
There aren't many. If I had to say, that's probably going to be one of the difficulties about comping this company to anything. I mean, you can look at the great big alts operators, and there's a couple smaller ones, but it's a really, really small comp set. So in some ways, they'll sort of be a benchmark. And I know there's a couple other alternatives managers looking to go public in the near future, and so that comp set's going to grow. But yeah, for now, unfortunately, there's not a whole lot for investors to benchmark them against.
I mean, I've never asked them, nor do I know. Why do you think they chose this route to go from a OTC company to a public company or to an IPO? Do you think it's really just to raise awareness for the company and possibly have a better currency for transactions?
I think that's a lot of it. I think they want better terms on their borrowing, which is not bad right now, but they'll get better terms, once they refinance that following the IPO. And they're not over leveraged at all. In fact, they could probably handle a lot more leverage, but you have more credibility and more clout as a public SEC filer than you do as a private company, effectively private. I mean, they've traded OTC, but let's be realistic. No one really respects that. And that's why it's been cheap for so long. But honestly, and they're taking a few chips off the table. If you look in the prospectus, each of the principals is selling about 10% of their holdings, and I don't blame them. I mean, they've put their heart and soul into this for the past couple of years and have made a fantastic amount of money for investors, and they probably want to buy a Lambo or something, and I don't blame them. And so yeah, being publicly listed and traded on the New York Stock Exchange is definitely a benefit, will benefit that. And yeah, and they want to build their war chest. I mean, up until now, they managed to buy these companies either in cash and taking on some debt to do it, or they've done it partially in cash and partially in convertible equity. But having a couple $100 million in cash on hand will enable them to write a check the minute they want to, next time they find a good acquisition. And yeah, and there's a lot of employees too beyond the two principals I mentioned here who deserve a chance to cash out a little bit and see the market give the company full credit for the progress they've made. And so yeah, I mean, I'm sure it's going to be a happy day at headquarters in Texas tomorrow, and they deserve it.
Yeah, as I recall with GlobalScape, unfortunately, like I mentioned, I did not own enough of it. But I recalled them taking some chips off the table, before selling the company for like 3 times more a year later. So, I get there's nothing ever wrong with taking some chips off the table, especially when your cost basis is, what do you think their cost basis is, like 50 cents, or would it be 90 like you had mentioned?
Well, I know what their cost basis is. 210 Capital, and that's Clark Webb and Robert Alpert, put in $4.5 million. $4.5 million to capitalize this company, and now they've made well over 100 times their money on this investment. And congrats to them. May we all be so lucky someday. Or
That is, that's a pretty good investment. That's not bad, right?
No, it's not bad at all.
No, they're risking $4.5 million. But they've done a good job. They've obviously kept shareholders. I mean, what's fascinates me about this company too is they're very, and I think maybe why we're both attracted to this, and many people on this call, they're so under the radar, right? They don't really promote themselves. You don't see press releases out unless they have to put them out. They don't give a lot of forward guidance. They give you a lot of information, but they there's no hype, right? There's no hype in the story, and they execute just quarter after quarter. And just when you think they won't do another deal, they do another deal. It's like I remember people tweeting about this. Oh, when are they gonna do a deal? And then a week later, boom, right? It's just consistently. So it's hard to say that they're not gonna. This will stop. They seem to be. It seems like a good value proposition for the sellers, right? And it makes sense for them to be part of this larger platform. So with that, do people have more questions? I know there's a lot of people on, and I know there's a lot of unknowns, right? We don't know how this IPO is going to go. I suspect it'll go well. I don't know how well, but it's been fascinating to see how the stock's traded over the last few days, and I doubt that really will have any impact on how it's priced. I'm sure it will be priced probably right in the middle of their range. What was it? Do you recall, Dave? It was 14 to 16 was their range?
14 to 16, and I'm feeling good about them achieving that or more. But yes, that was the range they listed.
And you made a comment earlier about their, the share class and how it could be excluded from index funds. So why do you think they chose that route to do the A and B shares?
Yeah, so for anyone who's not familiar, so the shares they're offering tomorrow will be Class A shares. And the shares that are currently out there, the ones that I own, the ones that management owns, everyone else are Class B. And 98% of the voting power will remain with Class B shareholders. Anyone who owns a Class B share and then sells it for any reason, it automatically converts to Class A. And they all convert to Class A under certain circumstances, likely a couple years down the line. And the reason for that, I think, is pretty simple. I mean, they don't want to give up control of the business. And not that they're doing that by floating only a small percentage of the company, but I think everyone wants to have it both ways, right? You want to be public, but you also don't want short-term shareholders or tourists trying to come in and tell you what to do. So what I think they want to just be in the driver's seat. If they go a year without finding a decent acquisition, they don't want to be on the hot seat for that. They want to be able to execute their long-term strategy without the pressures of quarterly results and the pressures of short-term investors that might not have the same motivations or the same understanding of the company that they do. Now, at the same time, this will likely have the effect of barring them from inclusion in certain indexes that take a dim view of multiple share classes. And so, I'm very, very confident in the management team, so I don't mind them taking steps to stay in control. But at some point, it would be nice if they made it into some indexes. I mean, if Warren Buffett certainly likes those passive investors because they're price agnostic and they stick around forever. So at some point, they'll be in the index, but it won't be a day one sort of thing.
Our next question comes from our friend Doug. Doug, good evening. How you doing?
Doing great, Richard. Doing especially well with my P10 Holdings this year.
What are you drinking, Doug? You said what do you bring?
I am embarrassed to admit it, but I'm actually picked a seltzer out of the pool refrigerator. I have to finish those off before wintertime hits.
No problem. I had one too.
I was thinking drinking a Hardy IPO would be a good Pittsburgh connection, but got to clean out the fridge.
Got it, Doug.
My question for you, Dave, is how do you think P10 is pricing their acquisitions that they make? In the past, I am much more unsophisticated investor than you, and if they signed a deal with an acquisition and said that the shares for their convertible that they paid in converted at $3 and the company was selling for $2.50, it was a pretty good bet to buy at 250. But I actually never figured out what kind of return they were expecting or how they priced their capital when they issued shares to acquire companies. Do you have any secret formula, or maybe not so secret formula, that you could highlight what you think they're paying for acquisitions?
Yeah, totally. So, and I have to say, congrats to Doug, because Doug was one of the only two other shareholders who with me made it down to the the annual meeting this last year. So definitely an under the radar company, but always nice to talk to Doug. But yeah, so in the early days, and I mean when I say early days, it was less than 3 years ago. If you looked at the prices they would end up paying for these alts companies, it was between 6 and 7 times EBITDA. And in the case of P10, EBITDA is very, very close to pre-tax cash flow because there is literally zero capex requirement. A couple of computers now and then is about all they ever have to spend. And so, I mean, the free cash flow yield was very, very impressive. Buying companies at that multiple, I think it's shaded up a little bit over time as they've bought some larger managers. I mean, naturally, the larger company you buy, the more you tend to pay on a multiples basis. But Doug's right. Historically, they would occasionally use some convertible preferreds to in part to pay for these acquisitions, and they would always price the convertible factor on these preferreds at a price at a pretty good premium to wherever the shares were then, and it gave you a good indication that management themselves thought the company was undervalued, and so did the seller, because they were willing to accept these preferreds that converted at a pretty good premium to the recent price. They've sort of moved away from that a little bit as their financial resources have increased. These last two little managers they bought, they just paid cash, and I think we'll see a lot more of that going forward. But it's been a nice little arbitrage. I mean, like I said, they've been buying these managers at 6 or 7 times, where their own stock was at 10 times, and then their stock was at 15 times, and they bought them and had to give up less stock to do the deal, naturally. And it's a virtuous cycle, and I think it continues, especially if the market is willing to give them the kind of multiple that I think it will once they're on the public markets.
Hey, Doug, what attracted you to P10?
I saw it in Dave's holdings, but I didn't fully appreciate it when I first saw it. And Tim Erickson was on a podcast, so it always pays to listen to podcasts. Plug. And
I agree, exactly.
He went through his business case for P10, and all of a sudden it hit me on the side of my head like, well, of course, this is why Dave's already in it before me. And I followed shortly. I would like to thank Dave, especially on this one. He wrote a upbeat note when it was selling at about 250. And normally I don't pay up for stocks. That's something I'm trying to learn how to do better. And that was the incentive for me to top off the tank and load it up. And so I got to add in at a pretty nice price. I had already bought some earlier, but I bought on the way up a couple times on this one, and I think it's something you can do with quality companies. And usually I buy trash cows, and it's nice to own a quality company for a different change of pace.
Oh, well, I was just going to say, to Doug's point, this company was not easy to understand from the get-go. I told a lot of people about it, and what a lot of people came back and said, so wait, so this company buys management fee streams on private equity funds? Like, well, what happens when the fund is done? What happens when it liquidates? And they didn't realize that, and wasn't clear from the way the company structured the deals, but they weren't just buying the existing funds. They were buying the rights to the management fees for all future funds that RCP and its fellow managers did. So a lot of people thought they were just buying a wasting asset that they were going to get like a single-digit IRR on, but no, they were truly buying a recurring revenue stream, if you assume that RCP would be successful in raising its next fund. And I had, of course, to do some research on their historical returns and their list of clients, and which was both impressive and pretty extensive. And that's what gave me the confidence to think that, yeah, RCP will be just fine. they've grown. They've been around for decades. They made it through a couple troughs and a couple cycles, and they came through just fine. And they'll be able to raise subsequent funds. But that was an important thing to make sure of before I could get confident and go big in the stock.
Doug and Dave, it looks like we have another question from the audience. Go right ahead.
Hi, Dave. I think we follow each other. I follow the rest of the listed alts and haven't really done the work on P10 yet. I wonder if I could sort of ask you two questions. The first is just to your point about, it's not just a fund, it's the next raise, and you got to have some confidence that they're going to raise the next fund bigger. I wonder if you have a view of, is there a number you would throw out there for, what it compounds FRE at, X M&A? And then the second is just, I imagine the kinds of stuff they're looking at, like the dials, and I'm forgetting what the name of the Neuberger Berman vehicle is that does, GP liquidity stuff. But I mean, who's the competition for these deals? I was shocked that you're buying anything in alts at anything in the zip code even of 8 times EBITDA right now. I would have guessed double that.
Yeah, hey, thanks for the question. We do follow each other. Thanks for showing up. Yeah, so let's see about that. I think it's sort of a different story at the size of the manager that they're buying. It's almost it's institutional, but not to the same level as these managers that have 10 or 20 billion under management. They are literally buying managers that have 500 million, a billion. So legitimate companies. I mean, many huge multiples of more than the capital that I manage, but it's sort of a different valuation spectrum than the real global institutional class managers that are out there. And honestly, I think part of their proposal for these companies is that they give them marketing capabilities that they don't have. For example, just the anecdote is that they bought TrueBridge, a venture manager, and TrueBridge had never raised in Europe, and so P10 took their team to Europe, and they were able to raise 700 million from Europe, from European investors for TrueBridge's next vehicle that TrueBridge couldn't have done itself, and that's a pure that's a pure revenue increase and a pure earnings upgrade for that business that they acquired. But I mean, you're right. There's not a lot of I would call it small cap alternative managers out there. It's just not really a thing that's been done and it's public. And so as far as fee earning assets goes, they're at 14.2 million at the end of last quarter. They've expressed that they'll be able to reach 16 at the end of this year, and I think that's excluding the nearly 1 billion they just bought from Aberdeen or ABDRN or whatever it is now. But they've basically said that, and this is less true as they add additional managers, but they have sort of a 3-year cycle where 1 year is a big raise year, and this happens to be that year. RCP especially is raising a ton of capital this year, and then they raise more capital in the 2 years after that, but the next big year won't be until 2024. So the average year is going to be different than whatever it actually is. But I mean, I can easily see them increasing AUM in the high single digits organically. I mean, as well as I do how strong the trends are in alts, and unless you think that KKR and Blackstone are going to run the world by themselves, there's plenty of room for some of these smaller operators to attract capital. If you look at the breakdown of where their capital comes from, it's exactly what you would expect. It's about half pensions, endowments, and insurance companies, but there's a pretty substantial amount that comes from family offices and plain old high net worth investors. And I think that's a bit of a sweet spot for them. I mean, you go to KKR and you want to give them $3 million and they'll laugh at you. But RCP will gladly take your check and another check from that, another 100 investors just like you, and they can raise a lot of a fund off of that. And so they're sort of performing a function for a sort of investor who's big enough to want to invest in funds of funds and things of that nature, but not big enough to go to the real giants, the real gorillas in the industry. Bit of a tangent there, but I hope that at least addresses a little bit of it.
Yeah, totally. I'll maybe add one more thought and then step off. I mean, I struggle with, we have Blue Owl that owns Dial now that's public, and the sense check on these alts is just like firm value to AUM. Is some of them, EQT in Europe in particular is creeping up on, like, I think it's almost 50% firm value to AUM. It's kind of nuts. Blue Owl is sort of in a 35 zip code. I mean, I guess the punchline is I'm guessing these guys are running like a 60% plus pre-tax margin to make kind of the numbers work, and it traded the type of multiple you're talking about. Thanks again.
Yeah, sure thing. And the EBITDA margin that P10 is guided to over the next couple of years is between 55 and 60%. So
There you go.
you're exactly right. It's a ridiculously profitable business, and that's probably why. I mean, if you honestly, there's probably a little bit of froth in the valuations of this segment, and that's another motivation for P10 to go public now. I mean, you sell while people want your product. It might not be the same a year from now, but they're not yet in that region. I mean, at a 2 billion valuation, and call it 17 million, that's what, like 13 or 14% firm value to be paying AUM. So they're still not in that upper echelon. But yeah, I mean, it's the valuations of these alt managers has just been skyrocketing lately, and I mean, I hope it stays like that, but maybe it doesn't.
Again, if anyone had any questions, please just send me and Dave a request, and I will let you in. Look, it's an interesting story. I'm glad I did the work. I don't know it as well as Dave and a lot of people, but I understand the management team. As I've gotten older, I've really appreciated some of these management teams that have histories of success, and Rob and Clark have had it, and I guess that kind of leads me to my next question. Do you think there's any conflicts with P10 and any of the other businesses that they are either on the board or run?
Yeah, interesting question. So these guys, and they seem to be able to put 30 hours into an unusual day compared to the rest of us. But yeah, P10 is not their only venture. Another business that 210 Capital owns a big chunk of is Crossroads Systems, which had a major windfall while participating in the second round of the PPP program. Interesting business. Not sure if there's a lot of franchise value there or not, but they made a huge amount of money recently. Another one, a very interesting one, again, and I own a couple shares here, is Alluvial Holdings. I mentioned the previous Real Industry, which was an NOL shell that crashed and burned. They bought a metals producer that was over levered and poor quality, it turned out, and went bankrupt. And now they still have like 800 million or so in NOLs, and they're out there looking for a business, and they have a $1 billion debt commitment from Goldman Sachs when they finally find something. But it's been a tough environment to find attractively valued investments of that size. So they're involved in that. There's a couple more too. They were involved in their 210 puts in capital into this recent SPAC deal. The ticker is GREE now. Looks a bit dubious to me, but they're running I think a coal plant in upstate New York to run some Bitcoin miners, and I mean, obviously I don't know how that works out, but they're involved there too. So yeah, these guys, they spread their bets around. This is not their only investment, but I don't really see I don't see any obvious conflicts. I mean, the businesses do very different things. They're not competing for the same acquisitions or the same capital. They have different staffs. They run independently, and of course, in 210 Capital is its own thing. It's the mothership. It has a big investment in P10, but it has other investments on the side, and I don't see anything wrong with that. But keep on reading the related party transaction section of these companies' reports, and call them out if you get worried if you see anything like that. But I've not seen anything that would make me question the company or the ethics at all to this point.
Just in terms of the trading optics, do you know what post transaction what the float will be? I mean, a lot of the stock is owned by insiders and portfolio companies, right? Portfolio advisors.
Yes, so they are offering 20 million shares in the offering tomorrow, and the underwriters have an option for additional 3 million. Of those, 11.5 million are new shares, and 8.5 million are being sold by existing holders. So they, assuming it prices at the midpoint, that's at least $300 million in shares that'll be free floating, and the insiders are locked up for 6 months. And so, I mean, this should trade with reasonable volume. And I mean, I say that from my perspective. I buy the tiniest little things that rarely trade. It's a wildly luxurious event for me to have a stock that I can actually sell whenever I want. So I'm looking forward to that. But yeah, I mean, it should trade basically like a normal small cap stock. There should be a bid and an ask, probably a nickel at worst, apart from each other, and that'll be a nice thing. So yeah, there should be plenty of liquidity.
There probably won't be as many days where the stock is down like 30%. You're like, what's going on? Oh, nothing.
Oh
Somebody
man,
sold.
there were a couple days this last year where it was very obvious that a small fund was getting margin called, because you would see that someone just puking shares into a thin market, and it was be down like 25%. And of course, I had to buy a little bit on those days. It didn't feel good, but I knew it was the right move. But I think you'll see fewer days like that, or probably none, after this IPO goes through.
Yeah, I was impressed with the the underwriters of this. For such a small company that's relatively unknown, that doesn't have tremendous organic growth, that they were able to get these kind of investment banks. I mean, really the who's who in financial services, which is comforting in some sense, that they're able to have these kind of underwriters and hopefully have good analyst coverage.
Yeah, I mean, you're right. You look at that list of underwriters, and it is, I mean, it's the bulge bracket stuff, right? It's a Class A IPO. I mean, as well as I do, you look at some of these IPOs, and you're like, oh, okay, this is. I'm not going to touch this because I see the names on there, and I know the kind of stuff that they trot out all the time. But no, this is not that. This is a real, legitimate IPO.
Right. And the other good thing is, I think maybe because this company went from a pink sheet to an IPO. I mean, there shouldn't be too many people locked up that are looking to sell first thing when this thing opens, since I'm sure a lot of people are selling in this offering that wanted to sell or take profits.
Yeah, so I mean, the float's always been super tiny. I mean, since they started building this business, they had 89 million shares out up until now, undiluted, and of that, management owned over 80%. And I owned a pretty decent percentage of their remaining float. I mean, not close to I had about 1 million shares at my peak. Maybe, actually, probably close to 2 million. But so I was a large portion of the float. But yeah, I mean, basically, I think if you wanted to sell before this point, you probably have. I mean, the shares, like you noted, have gone from $3 to the high 11s at various points over this last year, and there's been plenty of opportunities to get out if you wanted to. But yeah, if you wanted to sell, you had an opportunity in this IPO. There's, of course, you can look at the list of people who are selling in the offering document, and um, fine for them. But yeah, I mean, obviously there are some IPOs where you can tell this is just a hyped up company where people are just dying to get out, and they're going to do that as soon as they can. I mean, it's not some profit free cash burning hype job. It's a real company that is growing and has real cash flow. And so yeah, the chances of this being like a garbage barge that is just like last call to get off the ship are low.
Now, so Dave, I don't see any other questions, but I want to ask you, what's the next P10?
I have not figured that out yet. I think if you put pressure on yourself to find a P10 like every quarter or even every year, you're going to be disappointed. I mean, companies like this don't come along that often. If I find the next P10 in the next 3 years, I'll be thrilled. And I think my clients would likely be pretty happy too. But I think you can take a look at some of the characteristics and sort of create like a little checklist for yourself, like what you want in the next opportunity like this. And I think at the very top of that list is management quality. This would not have happened if you didn't have two guys as smart and connected and hardworking as Webb and Alpert here. And so if this next opportunity you're vetting to see if it could go like this does not have people of that work ethic and integrity and drive, then it's just not going to get off the ground. That would be the number one thing. And the economics are so phenomenal. That's another thing is This is a unique combination of an incredible business model and incredible people leading it. And without both of those factors, it never would have happened. So yeah, whatever is the next P10 has both of those, and identifying it early is the quest.
Yeah, exactly. In this case, I mean, you identified it early, but you had some time to do the work, right? And some time to get to know it, and it wasn't obvious probably back then because things haven't happened, right? And once they start happening, you're kind of first in line to do the work, right? That's how I kind of love some of these, right? It's like it wasn't a no-brainer then, right? Because nothing had happened.
Right.
And then you just knew them and you got to know them and they started executing, and it's been I'm really happy for you that's worked out so well. I mean, I know it's a big holding for you and you've been spot on this, and they've done really well, and it's really really great to see. I think we had another question again.
Yeah, I just figured while I have Dave and yourself on the line.
Why not? Exactly.
Yeah, totally.
You mentioned, I'm thumbing through their press releases here from the last couple, and they did the deals in cash. I mean, to your point about like how many of these 500 million, a billion, type of smaller asset managers that you can get for that cheap multiple relative to, call it, these guys trading in mid-teens. Like, what do you think about the pipeline for these deals? And like, I don't know if you know like an AMG, but like the stock actually just tends to work when you do accretive cash funded deals for inflowing assets. Yeah, that's the question. Thanks.
Yeah, totally. I mean, I don't think I can put an exact number on how many of these opportunities are, but I will say that when I went to the shareholder meeting last time, and they spoke to that, and they said that they believe that the pipeline is very strong, and they're not always they won't be able to do deals at this pace forever. Obviously, I mean they've done basically like one a quarter since the beginning of 2020. But that they don't see it stopping anytime soon. They said they're typically in serious talks at any particular time with between 6 and 7 potential investments, and obviously the majority of those are not going to work out for one reason or another. But I think sort of a prime opportunity for them is to buy sort of like a neglected, sort of non-core operation from a very, very, very large manager, like the most recent two acquisitions from Aberdeen. I mean, Aberdeen's a European giant, bit of a dinosaur, has some issues, and obviously will have some neglected operations somewhere with staff that would much rather be at a smaller organization where they have more control. And I think that sort of lift out of a team is a great approach for them going forward. And so, yeah, I mean, I'd be remiss if I tried to put an exact number on it, but I mean, just looking at the world, between Western Europe, Australia, Asia, and they've not even gone to places like that yet. And I think that's a possibility for them in the future. But there has to be dozens upon dozens of feasible acquisitions for them just over the next 5 to 10 years. And I hope they don't go too fast. I mean, that's a pitfall for any acquirer is integration and growing too fast, and you risk employee satisfaction, and you risk making a bad deal if you rush it too quickly. But if they can just keep on doing one or two a year and adding maybe 2-3 billion in AUM off their existing base, that's a pretty serious growth rate inorganically. And then if you add some mid to high single digit organic growth on top of that, you're looking at maybe 20% AUM growth for the next at least 5 to 10 years, and that could really be something special for the stockholders, especially if they do more deals in cash versus cash and stock going forward.
Hey Dave, I love that you and Doug saw each other at the annual meeting. I relentlessly I ask on my podcast, about annual meetings, and how was that annual meeting, the one you went? Was that your first of theirs, or had you been to a few of theirs?
It was my
Were there
first.
A lot of people there?
It was the first of theirs that I've been to. I talked with another manager who'd been to the year before, and he shared his notes, and that was helpful. But you're absolutely right. There's no substitute for meeting the people running your company face to face and talking to them and asking them questions. And I'm not even talking about them giving you any info that, I mean, I don't pump people for stuff they haven't disclosed otherwise, but we're just looking at body language, and you can pretty easily tell in the first 5 minutes if these people even want to be there and if they're excited about the company. And that says so much. And if they view it as theirs, if it's their baby and their thing, and they're pumped about growing its value, and if they want to know you, that's an exceptionally positive sign. And all of those were very much present at the meeting we went to. I mean, the formal portion is 5-10 minutes max, and they stuck around for I think nearly 2 hours, answering questions from me and Doug and the other guy who was there, and they never seemed like they were just looking at their clock, waiting to usher out of the room. I've been to meetings like that where I pretty clearly was imposing on them, but no, we were treated as partners, and it was very, very clear that even though they weren't willing to say a whole lot about their future plans, that they had a plan and they were excited about it, and they really, really believed in it. And it seemed achievable, and that was a tremendously valuable source of conviction for me.
Wait, so there were only 3 people there?
Yeah, that's right.
That does not surprise me. So this was this year then.
I've been to a lot of meetings where I was the only one, but it was nice to see. The night before I messaged Doug, I was like, "Hey, you go to P10? I know you live not too far." And he was like, "Yeah, let's meet up." So that was good.
Yeah, I don't think I've actually ever been to a meeting where there's only been 3 people outside of the lawyers and everybody.
Right.
And I love that the one guy had notes from the year before.
Right. Yeah.
People don't understand. I say this all the time. People are like, oh no, they're boring. I was like, no, they're not. You can get so much, especially with these smaller companies, because it's not like they don't have analyst conference calls, right? They'll talk to you, but sometimes it's nice to be around with other shareholders. Yeah,
I probably should jump off pretty soon, but one more anecdote from the meeting is the third guy who was there, who I didn't know. I got to talk to him a little bit after the meeting, after things had concluded, just in the lobby of the building, and he said he something like, I don't even know that much about P10. I don't really understand the business, but I've known Robert Alpert for a long time, and Robert Alpert knows how to make money. And so there are people like that, aren't there? I mean, we all know people who just have a nose for business and just know how to grow the value of an enterprise. And if you find someone like that, it's not ever that valuation is not important. It always is. But that sort of person can be a tremendous intangible asset to the company that a lot of investors won't figure into their valuation. And if you have the confidence in them to know there's something special, go ahead and throw that in the balance sheet in some way or another.
That's great, Dave. I think this is a perfect time to wrap it up. Thank you very much for joining us, and thank you everyone that got on the call.
Thanks, Richard.
Perfect. All right, Dave.
Yeah. Thanks everyone for jumping on. This was a great time. Maybe we'll do it again at some point. But again, thanks, Richard, for hosting.
All opinions expressed by Richard Sosa and podcast guests are solely our own opinions and do not reflect the opinion of Think AEN. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Think AEN and its clients might maintain positions in securities and investment funds mentioned. This discussion does not constitute an offer to sell or the solicitation of an offer to purchase any security or investment product. All information provided herein is for informational purposes only and should not be deemed as the basis of an investment decision or a recommendation to buy or sell the securities mentioned. Thank you for listening to the Riches in the Niches Investor Podcast. And until next time, don't forget to niche down.